My fellow investors, welcome back to the Newcomer Investor Channel. Today, I am so excited to once again have an episode with Asheef Lalani, one of our favorite guests. We've had so many good feedbacks about all our episodes. This is our third time, I think. And so, yes, very, very excited to have you back. How are you doing today?
I'm good, Anthony. Thanks for inviting me back. This is the only podcast that's invited me back, so I appreciate it. I like coming and talking to you. I think you have a great audience, and it's nice to be able to share my thoughts with them.
Yeah, appreciate it. Well, with that, a lot has happened since the last time we spoke, even though it was only like 2 or 3 months ago, maybe something like that. It wasn't long ago. But Strathcona, it's been such a soap opera, so I'd love to start with that. I guess if you could start just by summarizing where we were at last time we spoke, and then we'll get into what's been going on.
Sure. I think the last time we spoke, Strathcona had made a proposal to MEG shareholders, and MEG was going through the process of looking for an alternative to what Strathcona was proposing. Through their strategic review process, Cenovus, which is a company that's about 5 times the size of Strathcona and MEG, since Strathcona and MEG are pretty similarly sized, decided to make an offer that was mostly cash based. So their offer initially was 75% cash, 25% stock. Their stock has gone up a little bit, so it's closer to 28, 29% stock now and 71% cash. And the basically shareholders have been given a choice between continuing to be long oil via the Strathcona offer, or to sell to Cenovus for mostly cash. At what I think most oil bulls at least would argue is at the low end of where they expect the oil price to be over the next, say, 5 years. And so really it's a philosophical question of does it make sense to sell when the oil price is low, or does it make more sense to take equity in Strathcona and participate in the upside? And I will say the initial offer from Strathcona was also a combination of cash and stock, but it was um, you know I'm not the exact percentages, but it was almost the reverse, 80% cash and 20% stock or something to that effect. And after Cenovus made their proposal, and after Strathcona used their ability to accumulate more stock in the open market, they applied for basically applied to take their stake up from 9.2% to 14.2%, which is the maximum they're allowed to do while they have a tender offer outstanding. And they did that just before the record date for the Cenovus MEG vote. So
Oh, wow.
it gets kind of complicated with RISC-ARB situations. The dates really matter, and the timing really matters. And no one's better at this game than Adam Waterous and Waterous Energy, the Waterous Energy Fund, that is the major shareholder at Strathcona. They own around 79.5%. So they are a lot of them have deep backgrounds in investment banking in energy. Especially Adam, who he was on a podcast recently where he talked about doing over $200 billion worth of deals,
Wow.
energy deals. I think since he went to Scotiabank. So, he also started energy investment banking firm called Waterous, which he then merged with or sold to Scotia and became Scotia Waterous, and he ended up being the head of investment banking at Scotia. So it's a guy with a lot of experience. He knows what the competition is willing to do, most likely, in terms of how they can compete. And Cenovus is in a situation where their stock trades at a bit of a lower valuation than Strath does, a little bit lower, but significantly lower than MEG. So they're not in a position where they want to issue a lot of equity for the deal. It'll be dilutive to them, and so they have to offer cash,
Right.
right? And because MEG is such a small percentage of pro forma Cenovus, the synergies are that much smaller. So if you look at the amount of synergies let's say as a percentage of operating cash flow, it's less than 2%, the synergies for Cenovus from acquiring MEG. But for Strathcona, it's over 8%.
Wow.
So they can offer equity, much more equity than Cenovus can because the synergies as a percentage of cash flow or on a per share basis, depending on how you want to look at it, are significantly higher. And they're sharing most of the synergies, with MEG. MEG is getting the vast majority of the accretion in exchange for their liquidity, effectively, because MEG is a very liquid stock. It's in all the benchmarks and all the indices. Its shares are widely held. And by combining Strathcona and MEG, you end up with a situation where you're adding a tightly held company to a widely held company, and there are a lot of benefits of liquidity and flows that come into that because the larger float, Strathcona's float over time is going to be added to MEG's float, and that's going to result in a lot of index buying. But I should say, like, just in terms of timelines, I think it's important. We're recording this on September 29th. The vote for MEG shareholders to vote on Cenovus is on October 9th,
Oh, wow.
and
Coming soon.
coming very soon.
Yeah.
And the deadline to submit votes is October 7th in the morning. But every broker different brokers have different deadlines. So if you're a MEG shareholder and you're looking at this and you have to make a decision, I suggest getting it in this week. So before, I guess it would be October 3rd, which is the Friday. I think that's the ideally, and then you check with your broker, but you want to get your vote in so that it counts. And I think the vote should be no. I recently wrote an article in the Globe and Mail that was in the
Read it.
newspaper today.
Yeah, congrats.
And it details sort of my rationale for why Cenovus shareholders, or sorry, MEG shareholders should reject the Cenovus offer and tender to the Strathcona bid. The Strathcona bid expires on October 20th. So there's still time to tender. But I will say, it's unlikely that we're going to get to October 9th before something happens because, for my feeling, at least, just from given how much of MEG Strathcona owns, the hurdle for Cenovus is really high because the hurdle in a vote situation, which is like a plan of arrangement, which is Cenovus and MEG have come to, is that they require 2/3 of the shares that vote to be in favor of the transaction. So when you have Strathcona with already 14.2% against,
Yeah.
the turnout really matters. And the turnout has to be very, very much favored towards Cenovus in order for them to win, much higher than 2/3, knowing that there's already 14.2% against. So, in previous meetings, there might have been a 2/3 turnout. And let's say this time, Cenovus is obviously probably doing a lot of work. I know for a fact they are trying to get people to vote in favor. So they will likely increase the turnout more than it has been at previous like AGMs or annual general meetings where everyone has to vote. And so let's say there's a 75% turnout of shareholders for the offer. That means that if Strathcona had 10.9%, right, to get to 25.1% to vote against the transaction with Cenovus, that they will be unsuccessful in closing the deal. And now I assume that Cenovus has a good idea of where they sit in terms of whether they think that they'll be successful or not. My guess is they don't have the votes right now, and that they will modify their offer by the time we get to the vote and delay the vote. And because again they're reluctant to use their stock, rightfully, I think they should avoid using their stock because it would be dilutive to them. They're likely to increase the offer by adding more cash. And then we'll have to see how Strathcona responds. And Strathcona's in a really good position to respond by adding a cash option back to the transaction. They initially had a cash option, they withdrew it, went to an all stock offer, which I think it really showed that that's what this deal is about. It's not about being about MEG being sold if they go with Strath. It's about merging with Strathcona and continuing. They can, the shareholders of MEG will continue to own the assets that they own now. They'll get a bunch of other assets. They'll get higher margins. They'll get faster growth. They'll get better capital allocation. They'll get a higher dividend, and they'll get a higher multiple. So the advantages to MEG shareholders are really, really clear if they take the Strathcona offer. Whereas if they take the Cenovus offer, effectively it is selling out. So the reason why Strathcona has more flexibility is because they have a plan to distribute $2.14 billion to shareholders, whether they win MEG or not. And if they don't win MEG, then
Sorry, is
yeah,
that's the special dividend, right?
that's right. Yeah,
So are
yeah.
they're doing it also even if they don't or if they do get it? Sorry.
Yeah, so
Oh, that's
the way
new,
they
right? Yeah.
that was the change after they modified the offer to all stock.
Okay, okay.
They they said we'll pay out basically a $5.22 dividend versus the
Oh, okay.
$10 to reflect the new
Oh,
shares
got it.
outstanding, right? Because the shares outstanding
Okay.
go from around 214 million to around 410 million. And
Got it.
so it's just the 2.14 billion divided by each of those two
Right.
numbers. It's
Yeah.
either $10 or $5.22. And so, their plan is to do that post deal. And, in the article I talked about, effectively, that lets individual shareholders decide whether or not they want to their own buyback effectively, right? Because you're getting
Mhm.
a bunch of cash back. They can elect to receive it on a tax-free basis. And then they can decide, post dividend, whether they want to use that cash to buy stock or not themselves. And they can increase their ownership percentage of the company. So there's, the, a lot of the real knocks against that Cenovus has come up with have more to do with liquidity and short-term price change than they have to do with value, right? Because they can't really argue that they're taking away the upside on the from the oil price if you do the Cenovus deal. I mean, you do get, a little over 25% of the deal in stock, but that's 25%. It's not
Mhm.
100%. And if you own it and you own it in a taxable account, like a lot of institutions do, you're going to have to pay taxes on those proceeds. So you're going to have less capital then to reinvest. And so from an economic perspective, it's hard to justify going with Cenovus. But from a very short-term perspective, if you're really afraid that you're going to see a drawdown because you're confusing, that Strat's liquidity is low now, but once it merges with MEG, you get the combined liquidity. Liquidity is additive, right? So you will have lots of liquidity post-deal. Whether or not there'll be a drawdown is in question, but Strath is arming its shareholders with cash to buy stock if it does come down, which is really which is really just a terrific setup. Now, because they're already planning to do this, they could alternatively decide, well, if Cenovus is willing to offer a little bit more cash to make their bid more attractive, Strathcona could say, well, we'll offer up to 2.14 billion in cash as well at some fixed dollar price per meg. And if shareholders like, they can choose that, and whatever doesn't get taken up by shareholders, we'll pay that out as a dividend to shareholders, effectively doing a pre-buyback as opposed to a
Mhm.
post-buyback in another way of thinking, right? So using that capital to satisfy what some of the shareholders might want, because whenever you get into a risk arbitrage situation or M&A, you get a different group of shareholders that show up that are called risk arbs or
Right.
arbitrageurs as
Yeah,
it
yeah.
were, and they're trying to take advantage of the short term movement and basically from when the deal's announced to when the deal closes, if there's any improvement in the offer, if there's any spread, they're looking to take advantage of that. And they really like to be hedged as well. And it's easy to hedge Cenovus, the stock portion there, because Cenovus is very, very liquid. It's not as easy to hedge on the Strathcona side. And because it's all equity, it makes them a bit more reluctant to support Strathcona's offer because again, they're not focused on the long term; they're focused on the very short term. So, short term investors might prefer Cenovus, long-term investors should prefer Strathcona. So if there's a way for Strathcona to persuade some of these ARBs that they should choose their offer, it would be to include a cash option once again to give them a chance to take that and support the Strathcona deal. And 2.14 billion is a lot. It's like it would be over 30% of the shares outstanding for
Yeah,
MEG,
big deal.
depending on what price that's done at. So it can clean up a lot of flow back to the extent that there is any, because any long-term shareholder should not want cash in this deal because you want to be exposed to the volatility of the oil price. And if you're at what you think is the low end of the range, then you want all equity because you want to participate if the oil price goes up. And I encourage everyone to go look at Strathcona's website. They have a really good slide deck that responds to a lot of the objections from the MEG board to the transaction, and it just shows you that even if Strathcona were to stay at the same multiple it is now pro forma, then the oil price would go up to $80 a barrel, that the MEG offer is not worth 29 and change like it is now. It's worth 42. So, and that's where Cenovus, despite having the ability to borrow a lot of money and be able to put up a lot of cash, they can't justify paying that much more in cash because, you know, although we all think that the oil price is going to go higher over time, we don't know the path, right? So if it goes down first and you've really levered up, that's bad news, and that's kind of the history of Cenovus. So, their shareholders are very skeptical about adding a lot of leverage as well, and they don't want to issue equity. So they're kind of in a tough situation to really compete here. And if you look at the other side from a Strath perspective, this asset can always be sold back to Cenovus or sold to Cenovus at some point. There's no reason why several years from now they can't sell it to Cenovus, and so then Cenovus can take advantage of those synergies that they have, the few synergies that they have that Strathcona doesn't.
Right.
And
Sorry,
and so.
quick question.
Mhm,
This might sound naive, but I'm trying to figure out from the MEG perspective. I
mhm,
know before this Cenovus offer came through, a lot of MEG people didn't want the Strathcona offer. But now that there's the other one, why are so many of them still considering this other offer instead?
mhm.
Like, in what way is
Yeah.
that good?
Yeah, so it's interesting. I at first I was a bit perplexed, and I was trying to understand what the rationale was. And there's different voices I think that we're listening to. Some are focused on what's best for the asset as opposed to what's best for the shareholders, and I think they come from a very sincere place in that they like things to be efficient, and they want to do whatever creates the most, net present value, let's say. But and so they look at it and they say, well, Cenovus is right next door to MEG, and they both have Christina Lake projects, and so ultimately the synergies for the combined company are higher.
Mm.
Um, but those synergies aren't being shared with the MEG holders. And so that's the part I think that they miss. Like, I appreciate what they're saying and the argument that, yes, it makes the most sense. It's the highest NPV for MEG and Cenovus to get together for the sake of the asset. But if the synergies aren't being shared with MEG shareholders, then it's not really that useful to MEG shareholders. So I think they are focused on the efficiency part and missing what's best for them. And so I think that's part of it. I think there's also a lot of Cenovus shareholders that are masquerading as MEG shareholders,
Oh,
and they
I see.
see,
Yeah.
yeah, and I understand it. Look, I would hope they would just be very upfront about what their intentions are. Like I think I am. I actually own MEG and Strathcona now, um, but um, but they're focused on whatever's best for them, and that makes sense. That's what makes a market. It's why Cenovus is bidding in the first place. It is a good deal for them, and so their shareholders really want that to happen. So I think that's part of it. I think there's also this confusion around liquidity, and they're really worried about this short-term drawdown potential,
Yeah,
because no one wants to lose money in the short term or the long term. But the short term is what they think they can control, and so they want to avoid the stock trading down after, because they think that post-deal liquidity will be Strath's liquidity, and that's just a misunderstanding of market structure. And not everyone has spent as much time studying markets and working with markets to appreciate that liquidity is additive. And in fact, you could argue liquidity should grow with the combined company, because the market cap's a lot bigger. It's going to qualify for more benchmarks, and the float and Strathcona's float's being added to MEG, and it'll keep being more and more float will be added to MEG as Strathcona, or as Waterous Funds rather, releases shares to their LPs. So I think it's a lot of confusion, which I think is trying to be seeded by Cenovus to a certain extent. I'm not saying that they're misleading anyone on purpose. It's just you can frame arguments
of
whichever way
course.
you want that
Yeah,
makes
yeah,
sense
making the case
for
for their
you. Yeah,
team. Yeah,
yeah. And
no,
so
I
and they're
understand.
doing everything they can, and
Hmm.
I respect that. I just want to make sure that people understand the rationale behind the people who are against the Strath deal. I think the other thing that they worry about is they don't like the quality of Strathcona's assets. They consider them to be tier two or tier three. You hear this a lot from energy specialists. They'll talk about Strathcona's assets not being of high quality. And it's true that the steam oil ratio for Strath's assets are generally higher than MEG's assets. But that's not the only determination of quality. Basically, when you're analyzing quality, the margins are what really matters. And when you include the synergies on a pro forma basis, MEG's margins go up with Strathcona. So the
Hmm.
Strathcona pro forma margins are higher than MEG standalone margins. And so, if your question is like, if the question is like, do I stand alone? Because you can vote against Cenovus and not tender to Strath. And I think there are quite a few investors that plan to do that.
Okay.
But if your margins are actually higher when you combine with Strath, and arguably your quality's gone up, and a lot of that's coming because of synergies that from the combined company that again are a much higher percentage of Strathcona's pro forma production than they are of Cenovus. And so there's a reason you get that. And on top of that, there's financing synergies. Interest rates are lower. They get investment grade ratings. So there's a lot of other benefits of merging with Strathcona, most of which is a high multiple. When initially the transaction was announced, because we were at lower prices, um, the argument was like, we're not getting a big enough premium. We're not getting a big enough premium. And you wonder,
Yeah.
like, well, are you talking about the premium that you're getting versus the last trade? Because that's one way to think about premium. And the other way to think about premium is the multiple that you're getting paid on for the assets. Um, and I think in both cases, the premium that Strath is paying is higher than what Cenovus is paying, because just from a dollar's perspective, the value of Strathcona's offer is higher. And versus where the unaffected price, that premium is higher. And then I think more importantly, I think if you're a MEG holder and you're one of these MEG holders who's like, I'd rather just keep running my business the same way. I don't want any Strathcona. I don't want Strathcona paper or to sell to Cenovus. Um, but also they think that their multiple should be much higher because of the quality of the asset, and
Hmm.
it has a lot of characteristics of being a pure play oil sands and so on. Strathcona actually gives you that premium in their deal. So in the presentation, I went into this briefly in the article. Sonova says, hey, we're paying 7.5 times EBITDA, and Strathcona pro forma, even though they're paying a higher price, is going to trade at 6.8 times EBITDA. And you're like, well, if you're paying 7.5 times and that's a lower price than where Strathcona's going to trade pro forma, then wow, Strathcona must be trading much lower valuation and giving a lot of their valuation to MEG. Um, And if you're a MEG shareholder, I think it's time to say, if I deserve to trade at a premium, then I'm not going to sell my shares when I trade at a premium. Like
Right.
I want to own the equity. I want to take advantage of the premium that the market may give me because now instead of being a 100,000 barrel a day producer, I'm a 220,000 barrel a day producer. I'm still 100% oil exposed. I have, a very strong shareholder base now because the Strathcona shareholder base is more value oriented than energy experts, and so it's a very tightly held float. And so, not only are you going to come out at a higher multiple than you started with, but you're also going to benefit from potentially that multiple going even higher as this index demand comes in. And I think if you're Cenovus and you're looking at this, it's probably in your best interest to let the deal happen between Strathcona and MEG because it's going to bring valuations up for the whole sector
Right.
because everyone will compare to the Strathcona multiple post deal and because it's a because it's a technical thing about these all these flows that are going to go in, chances are not only is it going to get start off with a higher multiple, that multiple might continue to increase, especially when money flows back into oil stocks and people get excited about oil again, which is more likely to happen when oil's 80 than when oil's 63.
You were also already correct last time we spoke in that Strathcona, I think, is up 20 or 25% higher now compared to last time. I know you're talking about this is an
Right.
opportunity. This is going to be great.
Yeah, yeah, yeah.
And it's,
Yeah.
that's not bad.
Yeah. Yeah.
25%
So
in a
far,
couple
yeah.
months,
Yeah.
you know?
Especially with oil prices not doing that much since then.
Yeah. So
Yeah.
do you still feel, let's say, regardless of the outcome of this deal, do you still feel it's probably not bad value now in general?
Yeah, I think so. I think you want to partner with these guys. And the oil price is still at the lower end of the range. And if they're unsuccessful with MEG, you're going to get a $10 distribution,
Not bad at all.
right? And which will
Yeah.
bring down your, let's see, I think the stock's around 36 and a half
Yeah.
or so today. It drops down to 26 and a half. You're going to have over a 4% dividend yield, a
God, yeah.
4.4% maybe just off the dome, in terms of what that works out to. It's $1.20 a year, 30 cents a quarter. And so that's going to be attractive to yield buyers, I think. And the pro forma leverage post that is still not that high. Not that far from one times debt to EBITDA.
Oh, wow.
So their free cash flow then will be used to pay dividends, bring down debt. And I think the stock will probably re-rate somewhere in between pretty quickly between 26 and a half and 36 and a half. So I think there's still in the short term, I think you're in a good place if they don't win MEG. But in the long term, I think you're really in a good place because these guys I think they're just really smart at how they allocate capital and they really care about the price they pay. Whereas I find a lot of the energy specialists are very much focused on heuristics and just focused on the asset individually, and they sort of look at all the assets, and they don't think about, well, where's the best place to allocate capital across the
Mhm.
portfolio that's going to generate the highest returns, and that's ultimately what you have to do. And there's this view that you're better having a pure play so you don't complicate the story for anyone because it's so hard to get investors. And so I think, because we've been in this long bear market in energy stocks and resource stocks in general, and it's the same thing in gold and other
Right.
things, people rather have certain characteristics because they're more pure and they're more likely to attract investors to get better stock performance, but and ultimately a better multiple, right? And so you know, this deal for MEG shareholders gives them a bigger multiple, which I think they do deserve, and that will be, being being a really fast grower for any company their size, for being 100% oil exposed, for not having any mining operations, not having any refining or downstream operations. It's pretty easy to see that when the narrative turns and generalists are like, which oil stock should I buy? They're probably going to pick the one that has the most exposure to oil, and
Yeah.
doesn't right and doesn't have
That
a
makes
lot of
sense.
noise around it,
Yes. Yeah. Yeah.
and also has a very clear capital allocation strategy, which I would say across the oil patch, the capital allocation strategies have become very refined to focus on return of capital because that's the only way you
That's what they
survive
want.
being an
Yeah.
investor in energy was focusing on the companies that were giving you a return of capital. And Strathcona's plan is to return capital in cash, but I think they also plan to use their stock to do deals. And so that premium that Strathcona gets is really, really valuable because it lets them do really accretive deals. And so you're instead of like the standalone MEG strategy, which seems to be we hope our stock goes down so we can buy more back, which is a very, long-term way of thinking, but it's not very practical or fun,
Yeah.
way to own something that hoping that it always, goes down so you can buy more. I think you're better off playing from a position of strength and having the ability to do deals that are accretive because you gives you two ways to win, as opposed to just one way to win, which is buybacks. And you can tell with Meg, as a standalone, they bought stock back at much higher prices
Mhm.
because it was the only tool in their playbook in their toolbox. And so it's nice having more tools in your toolbox. You can take advantage of all kinds of different markets and you can play the cycle,
Yeah.
so that's why I think like owning Strathcona for the next 5 years. I said this in the Globe and Mail article that I think a 15% return a year is very doable. No guarantees,
Of
obviously,
course.
and my hurdle rate's only 10%. But when you just think about it simplistically, if you're at kind of around a 10% free cash flow yield after sustaining capital and you're growing 5 to 8%, that gets you to
Oh
15 to
wow, yeah.
so it's a simple
It's
way
not
of
impossible.
getting
Yeah.
there.
Yeah, yeah,
Obviously, but also if the oil price averages something higher, those numbers go up a lot. If they're able to do a bunch of accretive deals, those numbers go up even more. If they're able to play the cycle and the stock and the shares get undervalued at some point, once they buy MEG, buybacks becomes part of the toolbox, the toolkit too for Strathcona. It isn't right now because of the sort of smaller float, right? So
yeah.
so
It's
yeah, it's just a really compelling, I think, long-term opportunity to partner with, guys who are charging, very sophisticated investors like Fairfax, a
hmm
management fee and a performance
That's
fee,
true.
right?
Yeah.
And so you get the sidecar for free, which is like a major theme of mine. Most of my big investments, I'm sidecarring for the most part for free,
hmm
and that's a good position to be in, I think.
Well, one day you'll get to sidecar Brookfield as well. One of the favorites of mine.
Yeah, yeah.
Brookfield has done very well the
It's
last
done
year or
very well.
so. It's been
Yeah.
incredible. And you know what? Just to quickly touch on something you mentioned, right? This double
Mhm.
strategy of one being a great capital allocator and just great
Mhm.
business in general, but also if you're a commodity business and the commodity goes up, there's so much extra upside that's happening, right? I'm thinking
Mhm.
of another one which I love and I keep bringing back, Franco Nevada. Right? I don't know
Mhm.
if you followed this one, but the numbers are exploding my brain recently. The earnings report they
Mhm.
released a few weeks ago. It was a 99% adjusted EBITDA margin. I've never seen. I don't know adjusted EBITDA. It's kind of like bogus numbers, but still they always publish adjusted EBITDA, and I've never seen numbers like this. Same with their net income margins because gold is through the roof, right?
Yeah,
And
yeah,
every extra dollar of revenue it's just it's pure profits because
yeah,
they're not adding
absolutely.
costs or employees or anything like that. It's
Yeah,
crazy.
royalty companies benefit, and they're really favored by investors because of the returns are really, really high because they don't have to invest any capital for growth, right?
Yeah,
Or capex or
printing
maintenance
money.
capex or whatever. It all drops to the bottom line. The only it's not a knock on it, but there's not as much operating leverage then, right? So
Yes.
with an operator, you get a lot of operating leverage, and so the
Yeah,
earnings
yeah.
can go up faster.
That's
Whereas
true.
with Franco, your earnings are going to go up by the growth as new royalties come on stream. And others are depleting, but new ones come on, hopefully more than replace the ones that are depleting, which is usually what they try to do. And then the gold price or whatever commodity prices they're tied to. So you don't get as
Yeah.
much operating leverage, but you don't have the risk, as much risk
Mm.
of having to spend a lot of capital to keep production going in case there's a problem. And in mining, there are often problems.
Yeah, yeah,
You
yeah.
know,
But
and
I can tell you though, when I made that investment, I was thinking very long term. They had the Cobre Panama mine closure, which was a big
yep.
problem. So the stock price, it fell quite a bit. So I thought, okay, I'll start a position, and maybe in 5 years it'll come back. It's already doubled, and it was
Oh
like
yeah,
a year and a half ago or two
yeah.
years, right? That's crazy.
Yeah, well, your
So
timing was good, right?
yeah,
Because
thank you.
with the
Yeah.
gold price, well, also what the gold price
Yes,
did, right? Which is
exactly
something you
that.
couldn't control,
Yeah.
but you put yourself in a good situation because of all the macro situation suggests that the oil price, the gold price rather, should go up, and I think the oil
Hmm.
price when you think about the about oil as as an investment area, and I don't have much more than what I own in MEG and Strathcona in oil. So it's not like a giant bet for oil's not a giant bet for me. Gold's a bigger bet for me. Um, you know, and so, but um, oil on an inflation adjusted basis is extremely cheap, right? I mean, the oil
Hmm.
price was significantly higher historically than it is now, and if you inflation adjust, the prices are kind of unsustainable. And I think in Canada we have a real benefit in the oil sands because even though it's a commodity business, the nature of oil sands makes it sort of the highest quality of, let's say it's royalties first, then oil sands, and then
Hmm.
all the other oil and
Right.
gas companies to a certain extent, because you just have there's this giant upfront cost that has already gone into building the plant, that the incremental capital has really high returns, and the reserve life is really, really long. And so, when you think about, well, if the returns at like $60 oil are around a 15% return, 10% free cash flow, 5% growth, um, then what are you know, how high do the returns get when you have when you add the price going up and you get that operating leverage,
Hmm.
right?
Yeah.
And so if that's your floor-ish return, oil price can always go lower than 60 in the very short term. It's just hard to imagine them staying much lower for the
For
long term
years.
because
Yeah.
you have a big source of sort of production growth for the past 15, 20 years has been from I shouldn't say 15, 20, 10 to 15 has been from shale production in the U.S. And the way shale oil works is that it has very, very high decline rates once they
Hmm.
drill, and so it's a very short cycle where capital has to be reinvested in order to keep the production up or to grow. And because of that, when prices are low, in theory, the company should respond by cutting the amount of capital they spend, which they have been doing, which means that the oil production in the U.S. should start to plateau and come down, which it has
Hmm.
slightly. And so it's just hard, I think, as the inflationary pressures come through in the U.S., especially that they're going to be able to maintain the production. And not only that, it's been going on for a while now. So a lot of the tier one inventory has been already been picked over because, companies are incentivized to bring that cash flow forward as much as possible. So they drill their best stuff first.
Right.
And so what happens in some of these fields is that the wells get less oily and gassy and get gassier. And so the amount of oil that's coming out is lower, which means that the total revenue coming out is lower, which makes the returns worse. And so
Hmm.
they need higher prices in order to grow or even maintain production. And so, but with the oil sands, because the plant was built a few 10 years ago or whatever it may be, depending on which asset it is, that upfront cost is in, and so the incremental returns are very, very high, and their margins are high even in a low oil price environment. So even in this kind of environment, to still be able to generate those returns, it's a real opportunity, to own something that is gonna produce for a very, very long time and produce high returns, or at least acceptable returns over a very long time. I think return expectations generally are very, very high for investors right now. But I think this one, easily meets my hurdle rate of 10. And again, probably can do 15. And with the right tail on the oil price, could do a lot better.
Plus, when you think of right now, this market, I don't know how you feel about it, but I think a lot of stocks, or even the entire market, it seems a little overvalued, or maybe not bubble, but it's getting a little excited, right? But I think this is one where it seems like it's still a very good value play right
Yeah,
now, right?
I think the we've talked about market structure before and sort of where the capital is, and just like in energy or mining, people want quality. They want the same thing in other in every
Yeah.
other sector, and quality for like for a non price taker, like any of the Meg 7, or how I
Yeah.
think about it that
Yeah.
way. Those companies, or Costco is my favorite example. That's not a technology stock, but has steady growth. Um, it has commanded a very, very high multiple now because there's no reason to ever sell the stock, and because it performs, everyone wants to just own it, and they buy more because they know it's reliable. And so they're basically foregoing margin of safety on valuation in exchange for certainty of growth. And my only problem with that is I don't I don't have an ability to predict the forward multiple. And so if I
Mhm.
know that Costco can only grow 10% a year, then the only way I can make money more than 10% a year is if the multiple also grows.
Right.
And so I don't want to bet on the multiple growing unless the multiple is really low, right? So that's why I like setups
Yeah, yeah, yeah.
like Strathcona, because the multiple can grow and the price can go and the price of oil can go up. So so you sort of have you have operating leverage, and then you have leverage and the multiple too, as the stock becomes more popular, because people start to recognize what they're able to do, and how much they can what their returns look like over time. And so you give yourself you expose yourself to a lot of right tails, as I call it. When you think about
Hmm.
a normal distribution curve, getting to statistics, you have left tail, right tail.
Yeah, yeah.
You want sort of down, margin of safety is having downside protection on the left tail, and then being exposed to as much of the right tails as you can. And I think you get that when you sort of look for stocks that don't screen well, whether they be for quality investors in markets across the board, or if it's in a specific sector like in energy. Strathcona doesn't screen as well because some of their assets don't look exactly like other assets, even though they have other advantages, right? So like Strathcona has like higher steam oil ratios like we talked about, but it's also closer to has lower transportation costs, for example, and lower operating
Mm.
costs, and so
Hmm.
you get those benefits are just as valuable in margins as the steam oil ratio, right? So that those sorts of things get overlooked because people are micro focused on a certain heuristic, and they don't look across and see what the total returns look like.
Yeah, no, that makes sense. But that's all a very good strategy to put all the odds in your favor. And with
Hmm.
that said, I don't know if you're ready to talk about another stock that doesn't
Sure.
always screen very well, but that's equally exciting. Fairfax, which I have to remind everyone on this podcast, you were right. You and a few other investors right on this platform were right to predict that this was going to be a huge, amazing stock, and the returns over the last 5 years have literally been something like 500%. I have to check again, but it's something,
Something around there, yeah.
yeah, which is incredible. Let's hear some more updates about Fairfax. What are your
Yeah.
thoughts right now?
So I think last time I came on, I talked about how this period from like the end of June to the end of October is generally a period where the stock doesn't do well for the most part, and that's because it's a time where it's hurricane season in the U.S., and that's where there's a lot of risk associated with catastrophes. And so people they don't want to own a stock during this period because they're afraid they're going to get hit with big losses in the
Hmm.
quarter, and there'll be a big drawdown. And so they generally avoid Fairfax during this time. I think the math was 8 of the last 10 years. Fairfax has underperformed XFN, which is the Canadian Financials ETF.
Oh, wow.
And so this year is no different. It has underperformed once again. And it's underperformed partially because of the hurricane season, I believe. Also because all P&C insurance companies in Canada have kind of underperformed as people get worried about rate cuts, and what that will do to the interest income on the float. And they get excited about the economy. And so you've seen a rotation within the financials into banks and away from property and casualty insurance.
Hmm.
And I think that sets up a really good opportunity for Fairfax because much like it underperforms during this period from June 30th to end of October, it outperforms, from the end of October until the end of June. And so we're heading into a period where there's potentially a lot of good news. And Fairfax is a stock where it's really, active investors that are making the decisions because we don't have as many of the quant flows in Fairfax that you do in something like Costco or these types of companies. And so, people basically buy when they see good news and they see the intrinsic values growing. And because, analysts always expect there to be large catastrophe losses in Q3 as well. And given Q3 ends tomorrow, it doesn't seem like it's going to happen. There should be the earnings estimates should be too low. So I think there's a good chance they're going to beat the earnings estimates. I think the street is expecting something like less than $40 a share, like 39 or 38. And I think the chances are they will do much better than that. And
Hmm.
it's possible, over the next month, heading into reporting, which I believe is the end of October, they're going to the analysts are going to start increasing their estimates for Q3, and that will cause some quant flows still to come in because although we don't have all the quants, there are still some quants that care about value and they certainly care about earnings estimates changes. And so there should be flows into the stock, which will help ahead of the quarter. And then I think we'll see a very strong quarter as well. And because the catastrophe losses are generally biggest in Q3. It kind of gives you a really nice runway into the next 3 quarters being potentially good. Now there still could be terrible cat losses from hurricanes in October and November, right? The hurricane season doesn't end until later, um, I did a quick study and I used Perplexity, one of the AIs, and I think I used GPT-2 just to cross check it. But if you ask it, like if there hasn't been much hurricane activity up until this point, how often does it pick up after this point? And basically, it didn't have any
Not very often.
examples,
Yeah.
yeah, where there's any significant. Not, again, these are analogs, and analogs are only good for just for maybe placing odds, not as good for what's actually going to happen. So there's always exceptions to the rule. You can't just assume because the past was one way that the
Of
future is going to be
course.
another way.
Yes.
But as a bet, it's a pretty good bet to think that we're not going to have a really bad experience from here. And certainly, Q3 should look strong. And generally, the way I describe Fairfax is you're growing book value, 3 to 5% a quarter. And so if you're okay making money 3 to 5% a quarter, then you should probably consider Fairfax, as an option. And I think you're heading into again a period where you're going to get you know, a few quarterly reports that should be fairly predictable. And then you're also going to get, the by April you're going to get the annual report again and the AGM. And so it's just a lot of feel good stuff
Mm.
for the next little while, and the stock tends to do well during this period. And so I think for anyone who doesn't own it, I think it's worth looking at, especially when you look at what the rest of the market's done over the last little while. Fairfax kind of going sideways for 3 months
Yes.
is a pretty good opportunity, I think.
I've actually been thinking about adding, I,
Mm,
I I don't have all the cash required to add meaningfully, but it's one of, on
yeah.
my what do you call it, watch list where I'm thinking like, I might allocate a bit extra because it's one of my larger positions, but it's not outrageously low. I know for you it's like what, 50% or
Yeah,
40%?
it's like
Okay,
51.
yeah. So
Yeah,
I'm not even close
51%.
to that level.
Yeah. Yeah.
I'm just
I,
under
I, I
10.
did I did add though in the last month or so.
Oh, nice.
Yeah, I don't know why, except
I mean, why
um
not?
it just yeah, I mean once you're over 50%, you're like,
That's,
should I
yeah,
be, should
fair.
I be adding? But we've seen this trend of there not being any big storms so far, and the price kind of under pressure as people I think were again selling because of the rate cut and so
Yeah.
on. So I think that gave a nice opportunity to add a little bit. I very, very tiny, but sort of between like 2330 Canadian and 2400 Canadian. So
Okay, yeah.
not far from where we
Oh,
are now.
current price. So
Yeah.
what are your thoughts on this whole thing? I know the first time you and I met and spoke about Fairfax, we are talking about them entering the TSX 60.
Hmm.
And what is happening with that? Is it still Algonquin is there instead?
Hmm. Yeah.
What's
So there's it's getting more interesting because so the two smallest components in the 60 are Algonquin Power and Canadian Apartment REIT, I think it's
oh,
called,
okay. Yep.
CAR.UN. And both of those businesses, they pay out large dividends, or not that large, but they pay out dividends, and and their growth isn't necessarily that great. And so you can see how like their weighting is not going to go up a lot over time in the benchmark. So those two, in theory, if the committee wanted to, they could delete, and they haven't. They've chosen not to delete Algonquin, even though it's been um, around 20 points or under 20 basis points for the past year. But this is the lowest it's been at 16 basis points over that period. So there's a chance they're going to do something. I think we're closer to it. At the same time, I'll Tech is being acquired by or is merging
Oh, yes.
with Anglo
Yeah.
American, and that based on their current plan would remove Tech from the benchmark, and so that will open up a spot in the 60.
Uh-huh.
And so that potentially there's going to be one spot open because of that, and then potentially these other two are getting a smaller weighting in the benchmark, so the committee could decide to eliminate them. So there's a chance there's like three spots available,
Okay.
and with three spots, Fairfax should go in
They
because
need to be clear, right?
mm,
I think they're the biggest company that is not in the list, right?
yeah, yeah,
They're like 20 something largest company in Canada. Something like that,
yeah,
right?
something around 25, I think
Yeah,
now. Yeah.
that's
Mm,
you know what
yeah.
I mean?
Yeah, but so what's interesting is that there's three companies that are above 3% of the completion index, right? So there's when you think about there's the TSX 60 and there's a TSX composite, and everything inside the 60 is in the composite.
Right.
Okay. But everything that's in the composite but not in the 60 is part of what's called the completion index.
Okay.
And if you look up the ETF that BlackRock has, it's XMD is the ticker, and you can go
XMD.
look at the holdings and the weightings of that. And if you look at that, Fairfax is around 5.5% of the completion index.
Wow.
Now the next one is like Celestica, which is around 4.5%. And then there's like Ritchie Brothers RBA, which is around 3.5% or something. So those are the three that are sort of likely what the committee is going to choose from when there's an opening. Now, Scotia put out an index note. I haven't seen the index note, but I saw someone told me what they suggested would be going in. They think that RBA is the most likely choice to go in because it's an industrial, and industrials are underweight in the 60
Yeah.
versus the composite. So
Yeah.
so it may not be Fairfax as the first choice to go in. But I'm very happy just always being a bridesmaid with it going into the 60. I mean, I prefer that. The only reason I point it out is not to speculate on it, but to say, hey, if you've ever thought about buying the stock, you should buy before this happens,
That's true. Yes, of course.
because generally you see multiple expansion when you enter a benchmark. Intact Financial went in March of 2022, and it was trading around 2.2 times price to book, and it got as high as 3.2 times,
Right.
around 6 months ago or so. And now it's fallen back a bit as people have been selling property casualty insurance. It's closer to like I think 2.6 or 2.7 times book. So
Still very
it's
high. Yeah.
still higher than it was when it went in, and still a lot higher than where Fairfax is for sure. But so the opportunity is that if it goes in, that you're going to see big multiple expansion. And with Fairfax, what's really interesting, like you talked about how much the stock has gone up. So there are a lot more tax sensitive sellers now in Fairfax than there were, 5 years ago.
Mhm.
And Fairfax has, bought back a giant amount of the float over the past 8 years. I think they've bought back something like 6.5 or 7 million shares.
Wow.
And if you include and the TRS they have outstanding are effectively, buybacks and waiting. Eventually they are going to buy those shares in as well. And there's about 1.7 million shares on the TRS. So
Wow.
you can see like basically by buying all the stock back ahead of time, you've taken out a lot of the sort of the most price sensitive shareholders. And so the ones who are more likely to sell at a low valuation have already been bought out. And so there's a chance that when it gets added to a benchmark like the 60, that it will cause a much higher re-rating than say Intact would. And the company, had been kind of slow on buybacks, but picked it up again in August. They bought 150,000 shares and canceled 150,000 shares rather in August. And we'll find out what they did in September over the next 11 days or so, because they have to report that within the first 10 days of the month following. So
Right. Yeah.
they tend not to be very active on buybacks during hurricane season because you don't want to have egg on your face where you get hit by a really bad catastrophe and then you have to go raise money somehow.
Yes.
Um, Very unlikely now with Fairfax because of the position that they're in. They've never been in this situation where they have so much operating income coming from the float. They're making 2.6 billion on interest and dividend income a year, and it's really hard. I should say it puts them in a really good position to be able to take advantage of the stock price if it's weak, and so. It's been really good to see them accelerating the buyback again. I think in terms of catalysts, like we talked about the earnings beat, but chances are they're also going to buy in some of Allied World over the next six
Hmm.
months, which is a very accretive transaction, given how that's accounted for. Chances are they're going to buy back more stock over that period. And there's always a chance that we get some other big catalyst in the portfolio because the one thing about Fairfax is like we can see what's on the stated financials, and then we can make our own assessment of what some of the things that they own are worth. And sometimes we have very strong signals that something's worth a lot more, or the market's just
Hmm.
so low that you can make an estimate that's lower. So you look across the portfolio, there's Eurobank, which we know trades at a much higher price than where we have it marked, right? And so anytime they recognize they sell any, there's a big gain that goes in,
Hmm.
and they're selling some Eurobank basically every week now because Eurobank is doing their own buyback, and Fairfax can
Oh,
only
yes. They have
own
to reduce their stake
yeah.
in it. Yeah.
And Fairfax can only own a fixed amount, so they're
Right.
forced to sell into the buyback.
What a
And
good
so
problem to have.
it's a great problem. And every time they do it, they recognize a small gain, right?
Yeah.
So you have that gain, then you also still taking in the same share of earnings that you were taking in before,
Hmm.
which are growing. And so that's probably worth a lot more. It is definitely worth a lot more than where it's marked, and it's probably worth a lot more than where it's trading, given it's a
Yeah.
15% plus our return on tangible book value, or ROE. You probably shouldn't trade at only like 7-8 times earnings if it's got that high an ROE. It's kind of like Fairfax in that way.
Yeah.
It's like owning
Well,
another,
Greece, I think people are still scarred, even though this was 10 plus years ago, but you know how it is.
Yeah, yeah, and I think
Yeah.
that's right. I think if you're to think about what the biggest reasons why people don't like Fairfax, their portfolio is a big reason, right? Because people, if you're a quality investor, which most investors are now, the vast majority of investors are quality investors. They're looking for certain characteristics. And when they look at the portfolio, they're like, I wouldn't buy that. I wouldn't buy that. I wouldn't buy that. And so if
Mm.
they wouldn't buy what's in the portfolio, they don't want to buy the stock because they're like, I should have known better if it
Yeah.
doesn't do well, right? So it's a very, very difficult heuristic to get by. I think they'd be served by thinking these guys do it differently than I do. Clearly, they know what they're doing. They've compounded at 19% a year for 40 years. Maybe I should just sidecar with them and
Yeah.
enjoy the ride. And
Well, frankly, I think people should travel more too, because I'll be honest with you, right? Like Fairfax
mhm,
portfolio is very international. They
mhm,
obviously have some Canadian and American thing, but they have lots of other countries, right? But I feel like a lot of people, in North America, they're just too comfortable with North America and not always wanting to explore that there are other countries that have great returns or great
mhm.
initiatives as well, right?
Yeah, absolutely. And so we talk about like Eurobank, and then there's Poseidon, which is a shipping company. So that people don't want to buy a shipping company, but
Hmm.
it's a shipping company that's highly financialized. It's more of an infrastructure company, I think they would describe it as. And on our mark there, it's private, so we don't have a public mark, but I think it's something less than 8 times earnings as well. And last year at the AGM, you know, um, David Sokol was talking to a group of investors, and he said, he thinks it's worth, twice where they have it marked. So that's
Wow.
another, $2 billion of gains potentially that might show up at some point, might not, but
Yeah.
they do contribute to ROE in a very big way. When you have 3-to-1 investments to equity leverage, and you have investments that are making 15% plus ROE, they contribute to your corporate ROE at 45%, right? 3-to-1. So
Yeah.
it really helps pull up your overall ROE. And then you have something like you have the airport, right?
Yeah.
Bangalore Airport is gonna IPO at some point. But the point is that it's worth a lot more than where it's marked for both Fairfax India and for Fairfax the parent. And when they do IPO it and the mark changes, Fairfax the parent will also get a performance fee on top of getting the mark changed. So that potentially is $1 billion plus gain or adjustment to book value that could happen. And then finally, Key, which is another, which is not in the investment portfolio, but is a fintech insurance business that's co-owned with Blackstone. It just separated from Fairfax, from Brit, which was incubating it
Hmm.
this past January 2025. And when you read the incorporation details, the share, basically um, the shareholder agreement, they plan to IPO that at some point on the LSE. And my guess is that a fintech LSE listed, Blackstone backed, AI based insurance company that has grown from zero of premiums to a billion of premiums in 5 years is going to get a really big multiple.
That's
Probably,
good story. Yeah.
right? Probably like instead of Fairfax, which trades closer to 1 times premiums, maybe it trades at 5 times premiums. And so and you look at something like Digit, and it trades at a big multiple of premiums because it similarly is like a fast growth, business. So I think the potential for Key to get re-rated is, and again, it could potentially be another, billion or two of gains that people aren't expecting. And I think the important part about all of these gains, we don't know when they're going to happen. Even if they're going to happen, there may be something that changes that means that we don't get to see it. But to the extent that some of them happen, it's forward ROE that no one has in their model to come in. So like when I look
Yeah.
at sort of, well, where are the earnings? What's the earnings potential at Fairfax? There's basically upside everywhere you look across the investment portfolio in the insurance business, like via Key, but I think also in underwriting. I think the expectations for underwriting are down. One of the reasons why, besides interest rates going down, that people are selling their property and casualty insurance stocks is because the insurance market is softening, and so people are used to investing in widget companies, and so when they see the top
Hmm.
line drop, they sell, and generally it's always the right thing to do. And so that's what they do. 'Cause everyone's, basing their investment decisions. A lot of people are basing their investment decisions on these rules. Whereas for Fairfax, they when they look at insurance, it's just another capital allocation decision. So if it's a softer insurance market, yes, they will grow less, but they'll allocate that capital to other things like buybacks
Hmm.
and buying in the minority interests of like Odyssey and Allied World and so on. And so the potential here is that they actually continue to generate really high returns, even if the insurance market is slowing. And on top of that, Fairfax is fairly aggressive on reserving, meaning when I say aggressive, I mean they book a lot of reserves because they're trying to defer income, because you don't have to pay tax if you defer the income, and you
Yeah.
still get to use the float, right?
Right.
So
Yes. Yeah. Yeah.
so
That's
you
genius.
yeah, so you basically understate, it's kind of the opposite of Brookfield in that way. I think the way I think about Brookfield, I think
Hmm.
Brookfield is very good at putting really fair values on everything in their portfolio and then talking
Yeah.
about how big the discount is.
Yeah.
And it's fair. It's a good strategy if you want the stock price to be as high as possible. Whereas Fairfax does the opposite. They understate everything, way too conservative on their marks. And they're happy if to just buy back stock. They give you lots of information so you can figure it out yourself. It's just
Yeah.
most investors aren't figuring out themselves.
Yeah.
They're relying on their screens to tell them what to buy, and so they don't, and they miss out. I think because of that, because you have to use judgment. I think a lot more with Fairfax, and so because they book reserves, because their average claim duration is 4 years, they book reserves, on average for 4 years out, and so as you think about what was happening, what happens with reserves is if you have a negative development, you immediately take the loss, right?
Hmm.
But if you don't, then you wait for the 4 years to end before you start releasing the reserves,
Right.
right? Because
Yep.
you're like, okay, I over reserved. I have to start releasing these things now. And so, the hard market started maybe 5 years ago, and we started to see reserve releases tick up at the middle of last year. And when you think about how fast premiums were growing back then and how much they've slowed now, it's almost like I have to think of a good analogy for this. I haven't, but it's basically the reserves are growing. The reserve releases should be growing a lot faster than the
Yep.
premium growth,
Oh, I get it. Yep.
right? And so
Yep.
there's catch up, required.
Yes.
And thing is, you can look back from 2013 to 2018. It's a similar type of period where the hard market was, 5 years before that, and you start seeing the reserve releases like really tick up. And I think in 2013 they were like 3%. And then like the next year there were six, seven,
Oh,
they hit like
wow.
6, 7, 8%. So during that period, Fairfax was short the market, and people loved it that they were short at that time. But it's one of the things that keeps people away from the stock now.
Mm.
But it also had a price to book multiple that wasn't that different from what it is now, despite that. And that's because the insurance business, the combined ratios were really low. And so people were like
Mm.
really like the quality of the insurance business because of all the reserve releases that were happening. And that sort of, I think, kept them comfortable owning the stock. And so now we might have a situation where we have a lot of reserve releases coming through, such that the analysts who are expecting combined ratios to tick up might end up being wrong, and they might actually tick down.
Yeah.
And so again, so there's only two ways that Fairfax makes money, really. It's from underwriting and from the investments. And so both seem to have the capability of surprising on the upside, and that's really how you can get an ROE that's higher, much higher than 15%, like it has been for the past 5 years. Like I think it's still possible that the right sort of coin flip 50-50 over under on Fairfax ROE average for the next 5 years is maybe closer to 18%, not 15%. And certainly 10 seems really hard to get down to. But again, anything can happen. There are no guarantees, as Prem will tell you as well.
Yes.
You
And I
know,
like that he says that himself, right?
mhm,
He says, we expect over the next 4 years this-ish kind of amount, but no
mhm.
guarantees. Bad stuff can happen, right? They're very forthcoming. And I enjoy, reading all his old letters too, including when he had a few bad years in a row. It happens, right? But it's good to have that transparency.
Yeah, I think
And yeah.
I think I think with Fairfax, they're what I like to call expected value investors. So
Hmm.
they'll do anything that makes sense. I also consider myself an expected value investor. So I think that's why I think I have a lot more empathy for their bad decisions. Well, I shouldn't say they're bad decisions. The decisions that look bad in retrospect
Yeah,
is a more
but
appropriate way to say it
it's
because
impossible to predict, right? And anyone who's
Mhm,
worked in any business in general,
mhm.
like, it's not like the company always does the best fit, you know what I mean? Like,
Yeah, yeah,
so
but,
it's
but
the
but
same thing.
that's why like people pay a premium for Costco,
Yeah, yeah.
or for Intact or whatever, because because of the type of business, it's harder to make
Yeah, harder to
big
fail.
mistakes, right?
Yeah, yeah.
Whereas with Fairfax, they're making a lot of decisions. I think the part that people underappreciate with Fairfax is the mousetrap they built in terms of the leverage, right? Like that 3-to-1 investments to equity leverage ratio means that if you earn a 5% pre-tax return on the investment portfolio, you have a 15% pre-tax ROE.
Yeah.
And so, then underwriting, less the head office expenses is just bonus profit, right? So, I think if people appreciate that more, they'd be willing to pay a higher multiple.
But
Um,
also, look though, I feel like they're very resilient because again, they've had some moments when things were terrible, and
mhm.
they're still here. You know what I mean? They never got
Yeah,
wiped out. A lot of other competitors in that industry got wiped out by just one bad year,
yeah,
and
yeah.
they've
I
had
mean,
several bad years in a row. So that's I think that deserves some sort of premium as well. Just knowing that, like, look, you're not gonna be super profitable every single year, but you could have a
yeah.
bad time and you still be around and still strong.
And I think the point is now it's much better positioned than it has been because of how big the float is and where
Yeah, better than ever
where
before.
rates are, and also they're very thoughtful about the leverage, right? Like the debt is termed out. No one can force them to pay early, so their liquidity is in really good shape. And because they're so conservative, there are reserves everywhere. They have lots of investments they could sell if they needed to fill a hole if a hole were to happen. And so that the it's no coincidence that they've survived, even though there's been some tough moments, right? No question. Some really tough moments. They had to raise money, 20 years ago or so, in the equity markets. But because they have really good relationships and because they're very thoughtful about how they do things, um, the risk of that happening again seem a lot lower now than they were back then. The company has matured a lot, and they've done some really good insurance acquisitions over time. And having run them themselves now, they've really improved them. And like we said, because they're really good at reserving, there's a lot more margin of safety here than people think.
Yeah, and lastly, because I know you probably have to end soon, but
Mhm.
I their succession planning I think is so great as well, right? In that a lot of their execs have been there for a while. I know that Prem is the face of this and we love him, but I
Mhm.
think even when one day he chooses to retire, they're still gonna be great because they have this culture that they've, kind of everyone is, fully in that culture of how they look at investments and yeah, they're training the next generation too. So I
Yeah,
think they're in a really good,
absolutely.
yeah, good place.
Absolutely. Yeah. And I think also, I think the bigger they get, the more they've shifted towards more traditional quality investments. And so I think that might be, the next time there's a really big pullback in markets, I think it'll be really interesting to see how they position
Mm,
the portfolio. And so I think
lots of Costco this time,
yeah, yeah.
maybe.
I mean, Costco has to get really hit, I think, to be buying Costco. But yeah, or maybe they just buy they could buy the S&P 500 if there's a big
Right.
enough pullback, right? There's things they can do that they haven't done in the past. I mean, they did, when they had a back after the GFC where they had a big windfall on CDS and so on, because they were betting against the housing market and they were
Mm,
correct. They bought some quality businesses like J&J and some other ones. But then, because they had all these hedges on and so on, they end up selling a lot of those things.
yeah.
And so now they're in a much better position. They've never been so well positioned. And it's hard for people to pay more than they see as the last 10-year average for the price to book multiple. Like that's, people who are looking at it, they tend to analyze stocks based on their own history as opposed to comparing them to the peers. But if you compare them to the peers, it's clearly undervalued. Um, and and because you have this catalyst potentially with the multiple with the eventual index add, I feel very comfortable still buying it, even though it's 1.5 times book value, which again I don't think is expensive because it's less than 10 times earnings.
Yeah. Cool. Well, with that said, Asheef, this has been awesome. I love catching up. I love learning from you as always. Thank you so much, for sharing all these news. Is there one last bit of advice or feedback on either Fairfax or Strathcona you'd like to share?
Um, I mean, I like them both. I think if you're going to consider them for your portfolio, just be focused on the long term and take advantage of what the market gives you. So if you have pullbacks that don't make sense and things stock gets cheaper,
Hmm.
then take advantage of that. And yeah, just I think just keep up to date with the investments and just try to monitor them as you go along.
Love it. Long-term investing, that's what we're all here for. We love it. Asheef, thank you again so much for being on the show.
Thank you,
Thank you,
sir.
everybody, for listening. Make sure to follow Asheef on Twitter and on all your platforms. I'll be putting all your links in the description. And yeah, thank you for listening to the Newcomer Investor Channel. I look forward to connecting again with you soon.